Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about receivables. Mostly, we talked a little bit about cash at the beginning, but then transitioned, and we did a bunch of journal entries for basic accounts receivable issuance and repayment when we sell to our customers. Then we did the net realizable value of our accounts receivable and showed how we could calculate bad debt expense and do those journal entries. And then we talked about notes receivable, and we did the journal entries to record the issuance of a note and the repayment over time and the amortization of a discount, which works the same way as a premium. Now it's time to talk a little bit about the other ways we can use our receivables. You see, a lot of times companies don't want to sit around and collect receivables and wait for the cash. So they've come up with other ways they can use those receivables to generate cash more quickly. And the first way they can do it is with secured borrowing. Secured borrowing basically means that we use accounts receivable or notes receivable as collateral for a short-term loan. When we do this, it provides us a lot of benefits. First, we get the cash right now. We don't have to wait for it. So we have this money that we can use for other investments. Also, we typically get a reduced interest rate on these kind of loans because they've got collateral. They know they're going to get paid. Also, the payment schedule is usually more relaxed. You see, with most notes, you have a set payment schedule. You're going to pay X amount every month or every quarter, and it'll have this much interest and this much principal, and that's just how it works. But typically, when we use accounts or notes receivable as collateral, the payment schedule is based on our collections. So the contract basically says, here are the receivables that you've pledged. As you collect those receivables, you will remit the money to us once a month or once a quarter. So instead of my having to come up with $200,000 every quarter, I collected $100,000 this quarter, I'll send that in. I collected $300 next quarter, I'll send that in. I collected another $500,000, we'll send that in. I collected $50,000, well, that's all I've got, but that's what I'll send in, etc. So that's the benefits of using accounts and notes receivable as collateral. The negative side is that I'm still on the hook for this money, for this loan. So if my customers default and I don't get their money, if I have to write them off or they get cash discounts or they return some merchandise, I still have to pay the bank back. So I'm still on the hook for that whole amount. So there's pros and cons to this, but often does provide a significant benefit to companies to get this secured borrowing. Those benefits often outweigh the costs. To kind of solidify this, let's take a look at an example. Again, this is Jones Company. They've decided to use $1.5 million of accounts receivable as collateral for a $1 million loan, and that's typically what we see. You pledge a lot more than the face value of your loan. That's what gets that interest rate down, and to make sure that if people default, you still have the cash you need to pay off the loan. So it usually is bigger like that. They only want the loan for 6 months. The bank has agreed to accept the collateral, but they have to pay an upfront finance charge to offset some of this risk of delayed payments, etc. Interest rate will be 8%. Jones will make the payments at the end of each quarter based on the collections that they're able to make. So we want to start off with the journal entry to record the issuance of this loan, and we're going to do it for both Jones and for the bank. So let's start with Jones. We're going to get some cash up front, and we know they've charged us a finance charge of 2%, and then we're going to create not a notes receivable this time, but a notes payable. It's a debt credit balance. This is to issue a $1 million 8% 6-month note payable with accounts receivable as collateral. And usually, as part of this description, I would either refer to another document or I would provide a list of all the different accounts that are part of that collateral. So this is a list of my accounts receivable. Now I know the note payable is $1 million, and I know that on that $1 million I got charged a finance fee. So let's see, 1 million times 2% was my finance charge. That's $20,000. So I'm going to put that $20,000 up here, and the rest, let's see, 1 million minus 20 is 980. That's the money that I'm actually going to get from the bank. And that's usually how these kind of charges work, is they just keep back some of the money they give you. Now the bank's entry looks really similar. The only difference is, for them, it's a note receivable. And instead of a finance charge, for them it's finance revenue. And they're giving us the cash, so their cash is going down. And to save us a little bit of time here, we'll just abbreviate this. This is to make a loan to Jones. And I would put in all the details, and then I would list all of the accounts receivable that I'm getting from them as collateral. So same basic entry, same basic description, just flipping who's giving the cash, who's getting the cash. Now let's assume that Jones is able to collect over the first quarter about $400,000 of their collateral. Of course, they don't get all of that money. $25,000 of that was actually waived as cash discounts to get people to pay early so they could pay back this loan. So what we need to do now is we need to record the cash coming in and the payment to the bank, because once a quarter I have to take the money I've collected, send it to the bank. So let's see, Jones is going to get cash, $400,000 total, $25,000 waived, so we're going to get $375,000 in cash. Some of that, $400,000, went to these cash discounts. So there's my entry. This is the collection of accounts receivable. Now for the bank, I actually don't make any journal entries here because I don't care about Jones' collections. All I care about is getting my money when Joan remits it to me. And that's what's going to happen next. So Jones is going to make out a check to the bank for $375,000 because that's the cash that they collected. Now, we wish when we paid the bank that all of that went to pay off our note, but unfortunately it doesn't work that way. We always have to pay interest to the bank. So this is going to be Jones' first interest payment, or first payment, and we need to figure out the interest expense. So let's see. The equation for that, we take the principal times the interest rate, and we divide by the number of payments per year. So in this case, my principal was $1 million. The interest rate is 8%, but interest rates are always listed annually unless they specifically say otherwise. And in this case, it was an 8% rate. So I know that's an annual rate. If I'm remitting once a quarter, then I'm only going to have to pay a fourth of that interest because only 3 months have passed, not a whole year. So see, 1 million times 8% divided by 4 is $20,000. So I'm going to record interest expense of $20,000. So of the 375, $20,000 will go to interest, and the rest will go to pay off my principal balance. Now let's look at the bank. Again, it just flips. So they're getting the cash. For them, instead of interest expense, it's interest revenue. And notes receivable. First payment from Jones. So again, bank doesn't care about Jones' entry to collect cash. They don't care at all. And really, that entry for $375,000 and the $400,000 of collections, that's a summary entry. The reality would be is we'd make a bunch of little entries as all of our different accounts receivable paid us over the course of the quarter. And I've just kind of aggregated it into one number. Let's take a look at another one. Let's assume that in the next quarter, Jones received $500,000 worth of accounts receivable, but in this case, $50,000 of it went to discounts and $25,000 were returns. So they didn't actually get $500,000 in cash. Some of it, are these discounts and returns, and the balance is cash. Now, instead of me just jumping into this, I'm going to have us pause right here and let you take a crack at this. Should have come up with something that looks like this. Most people feel pretty comfortable about the first part of this entry, the cash coming in. We reduce the amount of collections by the $25,000 of returns, the $50,000 in discounts. What gets most people is actually the second journal entry for Jones Company, because they want to use the same $20,000 as interest expense. Well, as much as they would like to, banks can't charge us interest on principal we've repaid. So we need to take the $1 million minus the payment that we made, $355,000 on principal. That gives us $645,000 left that we have to pay interest on. So 645 times the 8%, again divided by 4 because it's quarterly instead of annually. That gives us $12,900 in interest. It's dropped a lot since the $20,000 that we had to pay last time, because we don't have this extra principal. And of course the bank's entry looks exactly the same. Now let's take a look at one last entry, and that is what happens at the end of the 6 months. This was just a 6-month loan. It was not a term undefined until all of your receivables have come in and you've paid it off. There's a deadline here. And unfortunately, Jones didn't get enough of their receivables back to get the payments taken care of for them. Instead, they're going to have to cough up some of the money themselves. So from the bank's perspective, they're going to get cash of $232,900 and notes receivable $232,900. This is the final payment from Jones. And for Jones, it'll look exactly the opposite. So it's a note payable for $232,900 and cash. Payment on note. Now, if you're not comfortable with how we got to the 232, let me just show you. This is our original notes payable account. We started with $1 million, and then at the end of quarter one, we repaid $355,000, and then in quarter two, we repaid $412,100. And that leaves us with our balance, if we do the calculation, of $232,900, and that's where this value up above comes from. Now I often get questions, wait a minute, what about interest? Well, it's a 6-month note. So first quarter, 3 months, second quarter, another 3 months, I would have made the payment for $425 and then turned right around and made the rest of my payment. No time's passed, no interest is accumulated. So really, this is about it. I just have to pay off the rest of that principal. And if I'd wanted to, I could have made one huge payment that was much bigger than the $425 that I'd gotten. Here I broke it down, but you could have just made one entry for it and sent one big check. Whew, isn't that fun? All these cool journal entries, right? I mean, this is just neat to see it all come together, and debits and credits and all this fun stuff. We're going to stop here though. We come back, we'll talk about the last way that we can use our accounts or notes receivable to make some money right away instead of waiting for collections. I'll see you then.